Most people think asset protection is about hiding money. It's not. Real asset protection is about structure, separation, and diversification, all done legally and before problems appear. In this video, I'll explain the 3 key levels of asset protection, including how holdings, trusts, and foundations work, and how personal geographic diversification protects you even if you don't own companies yet. Level 1 is about separating yourself from risk. If you earn income, own property, or run a business in your personal name, you are fully exposed. At this level, the goal is simple. Don't let one problem affect everything you own. Separate bank accounts, separate contracts, separate legal entities where possible, clean bookkeeping. Even if you have no companies, separation still applies. Don't concentrate all cash in one bank. Don't keep all assets in one country. Don't rely on one legal system. Lawsuits usually go after the easiest target, the most accessible assets. Separation increases friction, and friction protects you. Level 2 focuses on ownership structures, not just entities. Let's break down the 3 most common tools: holding companies, trusts, and foundations. A holding company owns operating companies, intellectual property, investments, sometimes real estate. Instead of assets being owned directly by the operating business, they're held above it. Pros: limits risk contagion, easier to sell businesses or assets, centralized control, strong lawsuit insulation. Cons: setup and maintenance costs, requires professional structuring, not a magic shield if misused. A trust separates legal ownership, economic benefit, control. You technically no longer own the assets, but you benefit from them. Pros: strong asset protection, estate planning advantages, difficult for creditors to penetrate, continuity across generations. Cons: less direct control, jurisdiction-specific rules, must be set up before disputes. Foundations are independent legal entities that hold assets for a defined purpose or beneficiaries. Common in civil law jurisdictions, international wealth planning. Pros: clear legal personality, high credibility, strong separation from founder, excellent for long-term planning. Cons: higher setup cost, less flexible than trusts, requires governance and compliance. Key difference summary: holding, owns assets, business-focused. Trust, ownership split, protection-focused. Foundation, independent owner, legacy-focused. Level 3 is about not depending on a single country, personally or financially. This applies even if you own everything in your own name. Key components: multiple bank accounts in different countries, property in different jurisdictions, assets held across legal systems, access to alternative residency or citizenship. This creates optional mobility and legal resilience. Residency controls taxation. Citizenship controls long-term rights. Political risk exists everywhere. Multiple options equals leverage. You don't need to leave your country. You just need the choices. Never rely on one bank. Never rely on one country. Even personal accounts should be diversified. Access risk is real, even without wrongdoing. Owning property abroad adds asset diversity, reduces seizure risk concentration, creates residency pathways. Even in your own name, jurisdictional spread matters. Most people fail because they wait until they're already under pressure, use aggressive or illegal shortcuts, copy structures without understanding them, over-optimize taxes, and ignore protection. Asset protection is about defense first, optimization second. Asset protection works in layers. Level 1, separation. Level 2, structure. Level 3, geographic diversification. You don't need everything today, but you need a roadmap. Subscribe for more deep dives on asset protection, international structuring, tax strategy, and global mobility.